One of the reasons that trading currencies has become so popular in recent years is that the FX markets are open 24 hours a day. FXCM trading hours are from 5:15 p.m. Eastern on Sunday to 4 p.m. Eastern on Friday. This means that the trading of currencies will follow the sun from trading centers in Asia to Europe to North America and then back again to Asia. So while a country's stock or bond market is influenced by the economic releases of their country, the FX market movement can be influenced by the economic releases from many countries. This gives those who would like to trade the volatile short-term moves caused by these news events many trading opportunities in a given month. However, trading the news is not as easy as it appears when looking at a 5-minute chart after the fact. The reason for the big quick moves is not that traders are all scrambling to get into the market, but rather because the big traders have a tendency to stay out of these situations, because they have a difficult time identifying and managing their risk. This leaves many of the individual traders scrambling to quickly enter and exit the market after a move seems to develop upon the news release. The result can often be getting in and out of the market at prices that are far from where you wanted. Now, why does this happen? Let's think about it for a moment. If everyone is looking to buy, one has to ask themselves just who is willing to sell to these traders. The answer more often than not is that there aren't many traders willing to take the other side of what may seem like an obvious winning trade at the price wanted by these traders. The result is that the market jumps to a level where there are traders standing by willing to take the other side of the trade, but at their price, not yours. No matter what market you choose to trade anywhere in the world, the reaction is similar. Many traders want to trade in the same direction, and very few people are willing to take the other side of the trade. This is what causes extreme volatility. Let's look at a typical market reaction to the release of non-farm payrolls. This news release tends to move the US dollar more than any other scheduled news event. In this example, you'll see how a new trader who really has no strategy ends up on the wrong side of two quick trades. After the news release of the non-farm payrolls, the market starts to move up and our trader enters a market order to buy. Because of the volatility, his entry price is around the 1.2210 level. Almost immediately, the market starts to move down, and since he only wants to risk 20 pips, he exits at 1.2190 at a loss of 20 pips. But then the market starts to move up again, and once again our trader buys at market. His entry price is at 1.2205. However, again, the market starts to move down, and he takes a loss of 20 pips for a second time, exiting at the 1.2185 level. Because of these two quick losses, our trader decides that trading the news is not for him. So if we know how difficult it can be to simply wait for a news release and attempt to place an order before anyone else does, how can we trade in these situations? The answer is, of course, to try to be the other trader who is standing by waiting to get into the market at a price they are comfortable with. Therefore, we should focus on developing strategies that can be repeated at every scheduled news release. These strategies must include identifying the currency pairs to trade, the news releases to monitor, and finally an approach to entering and exiting the market which can minimize the effect that the increased volatility has on the outcome of the trade. Which currency pairs are best to follow? Since approximately 90% of all volume in FX trading involves a pair which includes the US dollar, the US news releases tend to offer some of the best opportunities for a big move. Let's start by identifying the pairs that include the US dollar. These are known as the majors and they're listed here. Of these pairs, approximately 28% of trading takes place in one pair, and that's the euro dollar. Since the main reason of losing trades is the buying and selling at prices that are not at the level we wanted because of no liquidity, it would seem to make sense to concentrate on the pair with the most volume in an attempt to minimize the slippage of our orders. Certainly there will be situations where the other majors will be the currency of choice. Trading the pound during a Bank of England rate decision would be one example, but we should trade the euro dollar whenever possible. Other pairs to consider would be the dollar yen, which represents about 17% of daily total volume, and the pound dollar, which represents about 14% of daily volume. The rest of the majors each represent less than 5% of daily volume and would not be as good a choice as the top three pairs. In designing an approach to trading the news, it helps to understand that trying to enter and exit the market quickly after the release is a strategy that rarely leads to long-term success. As we stated earlier, if it seems obvious to buy a particular currency pair, and all traders are attempting to buy at the same time, there often is nobody willing to sell and take the other side of the trade. This leads to getting your orders filled at prices away from where you intended, which makes it easy for an apparent winning trade to turn out to be a losing trade. However, even with a certain level of potential slippage and uncertainty, some traders do prefer to try and capture as much price action as possible. Therefore, our first strategy, one we consider to be more risky, is designed to assist traders seeking this type of market approach. The basic idea behind this strategy is to identify a high price and a low price where you wish to enter the market and place your entry orders there before the release. Then, you simply wait for the market to decide which order is filled, the buy above the market or the sell below the market. The FXCM Trading Station 2 platform now offers a breakout pullback order specifically for this type of strategy. We'll show you how to use it in this example. A couple of minutes before the release of the non-farm payrolls, the euro-dollar is trading at 1.2820. Traders utilize the breakout pullback order type to place their buy entry at 1.2845 and their sell entry at 1.2795. The great thing about this order type is that both your buy and your sell entries are automatically created as OCO orders, or one cancels other. So if one of the orders is triggered, the other will automatically be removed or canceled. Remember, the strategy is built around uncertainty. You don't know how the market will react, but you're setting yourself up to take advantage of both options, a break to the upside or a break to the downside. After the news releases, the euro-dollar rallies and the buy entry order is filled. At the same time, your sell entry automatically cancels and is removed. A limit order to take profits is then placed 100 pips above the entry, and while that order is not filled, the trader exits and closes at a price of 1.2918 for a profit of about 73 pips. Now, as previously mentioned, you must accept the fact that there may be slippage on this trade, and that the fill may not be where you wanted. But with the FXCM no dealing desk option, the added liquidity increases your chance of being filled at the price you requested. The rationale behind this strategy is to see if the market is making a dramatic move in either direction as a result of the release. If it does move, we want to be able to get in on the move. However, we don't want the order to be triggered by post-economic release noise, which is the seesaw price action that follows every major economic release, whether the number is significant or not. However, if there is a big move, we want to be in the market. Now, one thing that traders have a hard time understanding is that professional traders actually take the time to read the news release before placing a trade or adjusting current open positions. The resulting lack of volume is one of the reasons that there is so much volatility right after the news release. Quite often you will see the market move strongly in one direction and then start to change direction, pick up speed, and continue in that direction for the rest of the day. When you see this happen, it's implying that the momentum traders have pushed the market against the trend and basically offered the professional traders an excellent place to open a position in the opposite direction. And that's why we recommend an alternative strategy to what we just discussed. The key to this second strategy is to wait for about 15 to 20 minutes after the release to see if the market starts to reverse. The trader can then open a new position in the new direction and most likely stay in the trade for the rest of the day. To execute this approach, traders simply write down the price of the pair just before the news release, watch for the initial surge, and then wait at least 15 minutes for the market to move back to the price the pair was trading at just before the release. Since it's most likely the big traders who are moving the pair in this new direction, traders should be patient and use a risk-reward ratio of 1 to 2. So after we enter the trade, place your protective stop 50 pips from your entry and look for a profit of 100 pips, or exit just before the 4 p.m. Eastern market close. Now let's look at a specific example. The market is trading at 1.1925 just before the release of non-farm payrolls. Traders initially pushed the market up to just below the 1.2000 level. After reviewing the release, traders pushed the market back down through the 1.1925 level, where traders playing the reverse sell and place their protective stop at the 1.1975 level. Finally, the market continues to sell off, and traders who sold at 1.1925 take profits at 1.1825 for a 100 pip gain. The initial risk was 50 pips for a 1 to 2 risk-reward ratio. The rationale behind this strategy is that if the momentum players fail to mount a sustained move, we know there are serious constraints that will stop the market from moving in that direction. If this occurs, the market is likely to reverse and move in the opposite direction. Now, more importantly, the longer we wait to enter, the lower volatility usually is. This can reduce the risk significantly. However, by waiting, we're not necessarily missing out on a promising trade. We're simply waiting for further confirmation and support on the new direction that the market is heading. That's why we prefer this strategy the most. Along with these strategies that we discussed today, we also recommend that traders utilize the daily FX Trading the News report. In normal market conditions, changes in the economic landscape tend to direct movements in the exchange rate, and the daily FX Trading the News report identifies and evaluates global economic releases that have the potential to move the currency market, along with the fundamental and technical catalysts that could help to mitigate the risk of loss. The different sections of the article depict historical movements following the data and key elements that could help traders analyze future price swings ahead of the release and market conditions that could lead to trading opportunities. Additionally, to further assist market participants with trading the news, Daily FX analysts also cover the major economic releases live in the Daily FX forums and walk readers through the release and the market reactions that develop before and after the data hits the wires. This concludes our video on trading the news. Thanks for watching and good luck with your trading.